Silver just hit an all-time high. But it's not because of electric cars or solar panels. What if I told you there's a $200 billion government crisis behind this spike? And you're probably not even seeing it yet. This isn't just another market trend. The truth is far more urgent, and it's about to shift everything you think you know about investments. Stay with me, because if you blink, you could miss the biggest financial shift of this decade. You've probably heard the buzz: silver is up, gold is soaring, and financial media is spinning a familiar story. Electric vehicles and green energy are driving demand. It sounds good, right? But what if I told you this whole narrative is missing the point? Sure, industrial demand is rising, but it doesn't explain why silver prices spiked by 4.5% in a single day. That's not how these markets move. Something bigger is at play. What you're about to learn is that this surge in precious metals isn't about the future of energy or technology. It's about a massive financial shock that could be just days away. The kind of shock that could force the U.S. government to suddenly find $200 billion to refund companies for tariffs. And here's the kicker: they don't have it, not ready, not planned, and they'll have to borrow it. But here's the real question: what does that mean for you and your money? Now, the real issue here is this: if the Supreme Court rules against those tariffs, the U.S. government could be on the hook for $200 billion in refunds. That's money owed to businesses who were charged unfair tariffs for years, and it's not something the Treasury has set aside. And here's where the market gets interesting. This isn't just about a court ruling. This is about a fiscal shock, an event that forces the government to scramble for cash. The Treasury will have only three choices: cut spending, raise taxes, or issue new debt. But cutting $200 billion from the budget? Impossible. Raising taxes that much? Politically unfeasible. So what's left? You guessed it: the bond market. And this is where things get dangerous for the dollar. What happens when the Treasury suddenly floods the bond market with $200 billion worth of new debt that wasn't planned for? The bond market has only two options: accept higher interest rates or see the Fed step in and print the money. Either way, the dollar's value takes a hit. And guess what the smart money does when that happens? They start buying silver, not because of green energy, but because silver is a safe haven, a way to hedge against currency devaluation. And right now, silver is moving fast. Here's where it gets even more interesting. The move into silver isn't just about smart investors hedging their bets. It's about market mechanics that are starting to crack. Silver's market cap is tiny compared to the bond market and even gold. So when the smart money floods into silver as a flight to safety, it moves fast. Picture this: the bond market is huge, massive in scale, but silver, the entire market for investable silver, is a fraction of the size. And when more money tries to pour into something smaller, it overheats. And that's exactly what's happening now. The price of silver is spiking because the door to escape the dollar is getting smaller. But here's the catch: silver is getting harder to get, especially physical silver. And the gap between what silver is trading for in New York and Shanghai, it's a sign of just how much pressure is building. In New York, silver's asking price is 88.16, but in Shanghai, it's 98. A $10 premium. That's not normal. And this isn't just a simple supply-demand mismatch. This is arbitrage. Traders are moving physical silver across borders, buying in one market and selling in another to pocket the difference. It's like the market is scrambling to find enough physical metal to meet the demand, and that could mean the price shoots even higher. Now, let's break down what happens next. If this $10 gap between New York and Shanghai continues, something significant is going to break. The physical silver market and the paper market are beginning to disconnect. What does that mean? It means the paper price of silver in the West is becoming irrelevant because there's simply not enough physical metal to support it. When those Western vaults start running low, traders will scramble to get their hands on silver at any price. And once that happens, the price could skyrocket. But here's the real kicker. This isn't just about silver anymore. This is about the broader financial system and the systemic risk that's starting to show. You see, when the U.S. Treasury needs to come up with $200 billion to cover those refunds, the bond market won't just absorb it without a fight. The interest rates are going to spike. And when those rates go up, the cost of borrowing for everyone, including the U.S. government, gets more expensive. The Fed can step in, sure, but printing more money, that's just going to weaken the dollar even further. And that's why investors are fleeing to silver. It's a way to protect themselves from what's coming next. A devaluation of the dollar that could trigger a global chain reaction. The question now becomes, what happens if this continues? If the U.S. government is forced to issue $200 billion in new debt, and if the bond market starts to buckle under the weight of it, the consequences will hit everyone. Interest rates will surge, and the government will have no choice but to print money to cover the shortfall. What does that mean for you? It means the value of the dollar could spiral downward, and when that happens, investors who saw this coming will be well ahead of the curve. They won't be stuck holding onto dollars or bonds. They'll be holding something more stable, something like silver. But here's the immediate problem. While silver is gaining ground, the physical metal is getting harder to find. The $10 premium in Shanghai is a signal that the system is beginning to break down. There's a massive push to pull silver out of Western vaults and ship it east. And this isn't just a temporary glitch. It's a warning sign that the precious metals market is under strain. So here's what you need to understand. The longer this pressure builds, the closer we get to a critical tipping point. And when that happens, the paper price of silver could collapse altogether. The only price that will matter will be the price set by those who hold the physical metal. Now, it's easy to get caught up in the panic, but let's step back for a moment. The truth is, this situation isn't just about one decision or one crisis. It's about a much deeper issue within the system. The mechanism that allows this to happen is the very thing that's been quietly fueling this financial instability for years. What is it? Leverage. Governments, financial institutions, and even regular investors have been using leverage, borrowing money to fund operations, investments, and government programs. And here's the real problem. When the U.S. government suddenly needs to issue $200 billion in new debt, the question becomes, who's going to buy it? When you face a fiscal shock like this, investors start to do the math. They look at the government's debt, its ability to repay it, and they start to question its stability. That's when you see a flight to hard assets, like silver, because they can't be printed. But here's the kicker. Silver isn't just a reaction to inflation. It's a reaction to the very system that's putting us on this path. An economic system where debt is the answer to every problem. And when debt becomes unsustainable, everything collapses. So what happens next? There are two possible paths we could take from here. Both are dangerous, but one is worse than the other. The first possibility is that the Supreme Court delays the decision, or that some form of government intervention kicks the can down the road. If that happens, we'll see a temporary reprieve, a momentary calm. The silver market might pull back and the price could settle down as people take a breather. But that's the best case scenario. Here's the one you really need to worry about. If the court rules immediately and those refunds have to be processed, the government will have to scramble for the money, and fast. This is when things go from bad to worse. The bond market will have to absorb a massive influx of new debt, and the dollar will come under extreme pressure. At that point, silver won't just be a hedge. It'll be the only real protection left against the fallout. The dollar's stability will be questioned, and the smart money will continue flooding into hard assets. The next few days could be decisive, and the choices investors make now will determine their positioning when the crisis hits. This is your window, and it's closing fast. Here's the bottom line. What's happening in the silver market is just a symptom of a much larger issue. The real crisis isn't silver's price, it's the system behind it. The U.S. government is facing a $200 billion fiscal shock, and the bond market is already showing signs of cracking. The dollar's stability is in serious jeopardy. And while the mainstream narrative continues to push the idea that this is just about industrial demand, it's not. It's about a financial system that's too leveraged, too fragile, and heading toward a tipping point. The real story here isn't green energy, it's the collapse of confidence in the dollar and the U.S. financial system. And silver, it's the first real warning sign. Now, as for what comes next, it's anyone's guess. The markets could stabilize for a moment, or the crisis could escalate quickly. Either way, the question you need to ask yourself is, am I positioned for a world where the dollar loses credibility? Because when that happens, silver won't just be an investment. It'll be your insurance. Stay sharp. Watch the signals. And remember, the market doesn't wait for confirmation. It prices in the crisis before it happens. Don't be the last one to realize what's coming. If you want to dive deeper into the historical context of financial crises like this, check out the link in the description. But for now, keep your eyes open, because what happens in the next 48 hours could change everything.